But if you take Coca-Cola, which we've owned, 45 years, whatever it may be, we don't have a thing to do with running that business, but it's a very good business. And when I say a very good business, I mean something that you can expect to earn high returns on capital over a long period of time. Now the question is, when you get into Google, or any of the AI companies, you're putting out huge amounts of money, and I can put huge amounts of money into government bonds and get, 20 or 30 or 40 billion dollars a year in terms of payments from them. So a good business is one that earns a lot more than and has prospects of continuing to earn a lot more than the returns on essentially riskless investments, which you could define as treasuries. But if you take something like American Express, most of the banks earn 13, 14% on capital. If I asked everybody to guess what American Express would, they would come up with some figure similar, but it's so different that it earns 30% plus on capital, and it does not incur more risk in doing so than the banks that earn 13 or 14%. And the trick in life is to find, in investing, is to find businesses that are going to earn high returns on capital for an extended period of time. And that's what happened with Berkshire for a long period of time. A long period of time gets to be very important because those doubles later on are very big numbers. But Charlie Munger, my partner for decades, he just pounded the idea that it wasn't a good business just because it was doing sexy things or whatever it might be, but if it wasn't earning real cash that it would or be expected to do it in a very short period of time, and just be able to distribute it if it wanted to. Better yet, if it could reemploy it as a business, it was even better than one that had the ability to earn high returns, but you couldn't deploy the excess capital of those returns.